But yeah, we're gonna move on to the indicators part. Again, I don't primarily use indicators, but the indicators I use is VRVP, so I'll go over that. I also have in the past I've used almost every single indicator that's known, and in the end, I've just gone with price action. That's just because it's me. It works for me. But JP here, he's been trading with indicators, and he's very good at it. Correct me if I'm wrong. You use SMAs or MAs? Which one?
Well, I wait. First of all, let me take this disgusting Oatly chart off my screen. I can't do it. I can't deal with it anymore. So I use a combination of two things. I use daily SMAs, and I use a very specific script for that. If I don't know if maybe you want to open up the indicators and I'll tell you what it is, so you can
Sure.
explain it.
Yeah.
So if you type the following, you're gonna see them. It's called daily,
Hmm.
and then SMAs. You can put a space. Yeah, right there
That's
by
all.
Immortal Free. Yeah, click on that.
Wow. Look at you.
So that's the 10-day, the 20-day, the 50-day, 100-day, and the 200-day SMA, simple moving average. And basically, these are static moving averages, which I use on my chart to show me where we are trading on the daily simple moving averages. This stays on your screen statically until the end of the day where we add the new day into the moving average, right? So that's why I always say, oh, we're going to bounce off the 10-day SMA, or we're going to bounce off the 50, or we're going to bounce off the 200. These are static. These are for me, whenever we break a major SMA on the daily, for example, you're looking at the daily right now.
Yeah.
And do you mind if you close the just X out of there? Yeah. So just look at that green line. You see how it's at 108.89?
Mm-hmm.
Now click on the 5-minute chart. And you see how it's at 108.89?
Yeah. So
Yeah. So
so
these
it
are
just stays the same. Yeah.
these are major levels. Yeah. So the daily SMAs are always on my screen because I like to see where we are in comparison to major moves and if we're breaking below moving averages. It's actually really cool because when I look for swing trades, I try to find major SMA crossings. Like for example, um, my colors are different, but it doesn't matter because we can basically figure this out. If you look at, for example, the purple line and the blue line,
So 10 and
right?
20. Yeah.
Yeah, the 10 and 20,
Mm-hmm.
you can see that there was a bullish cross all the way back in May on Nvidia on the daily, all the way back in May of last year, right there.
May.
Boom.
Oh, okay.
A
Yeah.
little bit up. There you go. And
Right.
there was your bullish cross on the daily, which this to me is a signal that we have bulls in control. And as you can see, when the 10-day crossed the 20, what happened? We just had upside momentum and rewrote the 10-day SMA on the daily all the way up. Um, all the way up to I think it was the high. Yeah,
Yep.
to
140.
140.
Mm-hmm.
Yeah, so I use those for swings. And then when we eliminate the SMAs, if you want to just
Wait.
take the daily SMAs off really
Wait.
quick.
So I'm gonna ask you questions.
Yeah,
As if
go.
I would ask you questions like I don't know how to do this, so people get a little more clarification. So, in this case, we're gonna reiterate the 10 SMA. The 10 MA is the pink one, and the 20 is the blue one.
Yeah, you
So
can
for
turn off all the other ones really quick. That way we can just yeah, just turn
okay.
yeah.
Okay, so what you're saying is when the 10 SMA is the one that's above the 20 SMA, it's
Correct.
bullish. And then
Correct.
whenever it's the 20 that's above the 10, it's bearish.
When
So
the
that's
10
why
crosses the 20 to the downside, it's bearish. When the 10 crosses the 20 to the upside, it's bullish. Correct.
gotcha. Okay, so yeah, as JP was saying here, you have the crossover here, the pink one, which is the 10, and the blue one, which is the 20. It's a lot more bullish, and you could see, even if you disregard this, you could see we creep up all the way, and then once we get the crosser over here, where the pink goes below the blue, you could see the bearish sentiment, and you could see it again. We have a crossover here, bullish, cross again, that's bearish. So yeah.
Okay. Now, take into account that they because a simple moving average lags in comparison to an EMA. An EMA is much more reactive But what I like to do is I like to use the SMAs for swing trades on a daily, right? So when I
Mm-hmm.
see something approaching a 10-20 cross on a daily SMA, even if there's a pullback, I'm okay with it because I know that the short-term SMA, right? In this case, the 10, I'm sorry, or
Mm-hmm.
let's just call it the fast-moving SMA, the 10, is in
Yeah.
control. Does that make sense?
Yeah. Sorry, I got distracted. But yeah, go on.
Yeah. So I use that for dailies. Now, for intraday trading, I prefer to use EMAs because they're more reactive. But again, I use the SMAs for swings and I leave them on my chart because it shows me where we're trading in comparison to the major moving averages. But this is just a very simple, this is trading 101. The first thing they teach you is 10 crosses the 20 on the daily, it's bullish. 10 crosses the 20 to the downside, it's bearish. But now if you take off the 10 and the 20 and you add the 50 and the 200, no, you can take off the 100. Not the yeah, and go all the way down as far back as you can. Right, okay, right there. So this is called the golden cross, which is when the 50 crosses the 200. And in this case, the red crosses the green. Do
Yep.
you see where that happens?
Yep.
Yeah.
Yeah.
So right there, that is a golden cross. And when you have a 5200 cross on the daily, forget it. That's the ultimate signal to go long. So if you would have caught that 5200 cross back in what
January
year was this?
2023.
January 23rd, right?
You would have
Is that
Nvidia
it?
at
I'm sorry.
$17. 18.
Yeah.
Yep.
And then look at it just continue riding. It keeps going, keeps going, keeps going. And you can see that even during COVID, right? It never crossed under the 200. You see that?
Nope. Yeah, it never did.
Wow, no?
Yeah.
I mean, there was, if you go back to, let me see, when did we, oh, you're looking at the weekly,
Mm-hmm.
February. Yeah, there was a downside there, but go all the way to where we had a weekly cross on the 5200. No,
Back here?
no, further to July. No, to the right. Move to the right.
Oh.
No, no.
Where?
No, keep going. Move your mouse to the right. Move your mouse to the right. Keep going. Keep going. Keep going. All the way. Further, 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 further. Keep going. Keep going. Now go down right there. See that
Yeah.
5200 cross?
Mm-hmm.
That was at $16. And when was that? That was January what?
January 2023. We just did that one.
Nvidia was trading at
Yeah,
$16.
you did. Yes. Where have you been? What do you? What do you? Well, no. This is before stock. No, this is after. This is before stock split.
Oh my
Prices
God.
adjusted. Yeah.
Okay.
Yeah.
Okay.
Yeah.
No,
Calm down,
Jesus
JP. No,
Christ.
Nvidia wasn't in $17 in
Oh
2023. All
shit.
right. Yeah.
Okay. Yeah.
It was around. I think it was
It's
around
right
200 or
there.
300. Yeah. 200, 300 was where it
Whatever,
was.
whatever the hell that was.
Yeah.
Okay.
I remember
Look,
I got calls here.
yeah,
Parabolic. Yeah.
and
Go on.
look at
Sorry.
if you would have held it since then. Look at it. Look at what it did. Did the 50 ever cross underneath the 200? No.
New. Still hasn't.
So this is an example of what's known as the golden cross.
And
And
also.
you can tell
Mm,
that on the weekly, we've never broken down below the 200 SMA. You see that?
yeah. Wait.
So
What?
Nvidia has
Yeah.
never been bearish.
Correct. Long term. You mean?
No, it's never been bearish.
Yeah.
Ever.
And,
Ever.
and I also want to add something to what JP says. Also one thing is the distance between the SMAs also indicate the strength of the momentum, right? So the
Right.
closer they are shows that it's tight. Similar to Bollinger Bands, right? There's not so much movement, but the farther it gets apart indicates how strong and how volatile the movement is. That's why you see, compared to the times where the distance was small, the moves were less parabolic. But then once it became very distant, that's when the moves were very volatile. So you can see we start creeping in again, and I'm glad JP brought this up. To a very spaced out area. So that means the movements up here are going to be very volatile for the coming weeks. Yep.
Yeah, so I use that for swings, and then of course, you can take that off, and then I use what a lot of people probably use, which is just if you want to pull up the EMAs to explain how they act, you
Yeah,
can just
sure.
type uh the following, and it'll give you the entire stack. You just type the number six, and then there you go, exponential moving averages. Yeah,
Oh God.
and then I'll tell you the colors, so that way you can so
Now I
you can
feel like I'm in a
understand.
pride parade. Yeah.
Yeah, I know, but I'll explain to you what colors. So the one EMA is blue. So I'll tell you just it doesn't matter. Just yeah, any blue is fine. You turn the two off. Turn that one off. The three make it yellow. The four make it red. That's fine. And the six turn off the five. And the six make it purple.
Oh,
That's fine.
okay.
So
I
here
turned off the
are
two
your
SMAs, right?
yeah, it doesn't matter.
Yep.
Here are your exponential moving averages. And now you can go over to the 5 minute chart.
So just
And
to reiterate, just before JP starts explaining, like the whole EMAs thing, that's what JP uses for day trading versus SMAs he uses for swing trading.
for bigger
Yeah,
swings, correct.
yeah,
So the cool thing about exponential moving averages is that they're more reactive to price than simple moving averages. So for example, one of the most basic of trades that you can take when it comes to trading 5 minute charts with EMAs is the following. Can you move the chart to yeah, exactly. Uh-huh. Go all the way to the top, right below where it says Bill Gates. So here's a perfect example of taking a an EMA crossover trade on a 5 minute chart. So here you have price, right? Trying to break below the 9, the 21, and the 50. The 9 is the blue, the yellow is the 21, and the 50 is the red. So essentially, what ends up happening is because all of those EMAs are stacked really tight, as soon as the fast moving EMA crosses over the slower EMA, in this case the 21 and the 50, you're going to see a push to the downside, and it's normally going to target the 200 EMA, in this case the purple line. So can everyone see how the blue line crossed over the yellow and then crossed over the red, and it pushed price down? It pushed price down all the way down to the 200 EMA. And if you notice, it's bounced off the 200 EMA, and it rejected both the 9 and the 21 and the 50. It could never get back above it. So this is telling you that the faster moving EMAs are pushing price down. So then essentially what ends up happening with price is that as price is pushing down and the exponential moving averages or fast moving averages are pushing price further down below the 200, you can see that price continues to break down. And then this is a continuation trade that you want to be in. Can you see how the red crossed the purple on the 5 minute? That is known as a death cross on a 5 minute. So what happened? Price kept pushing further down, and it pushed all the way down until it reached the level. And I'm almost certain that if we were to go to the daily chart, that 145 is probably a daily level.
let me see one sec. 145, you said?
Whatever, wherever it was that we bounced off the yeah, look right there. See?
Yeah, right
Yeah,
here.
so that's a perfect example of how you can use a 5 minute chart with exponential moving averages to push down into a level. And the reason you stay in this trade is because the moving averages continue to push down. You have a 921 cross, which is a signal to go short. Then you have the 9 crossing the 50, which is a continuation of the short. Then the 50 crosses the 200, and we could never break back above the 9, the 21, and the 50, and the trade continues to go down. So you would have taken NVIDIA from 149 all the way down to 145, and the only reason you would have gotten out of out of this trade would have been if you got would have had a break and close above the 50, which is the red line. That
Okay.
would have been the only time you would have gotten out of this trade. But the way that you trail your stops on this is that what you do is you follow the 21 EMA, which is the yellow one. So you keep sliding your stop and sliding your stop and sliding your stop so that it's following the path of the 21 EMA, right? And you give it some room to breathe because you're always going to have a little bit, where it's going to pop above it and it might try to grab some liquidity above it. But that's why you have the 50. And the 50 serves as another barrier wall. So you could follow and trail your stop above the 21 or the 50. And then just let the trade go with the EMAs. This is a very simple trading method that a lot of people use. And it's not that sophisticated. Does it always work? No, because exponential moving averages are a lagging indicator, and the only true real time indicator that tells you what's happening is price action.
And
But
volume.
when and volume, exactly. But when all of these things are working hand in hand, both price action, volume, and you have exponential moving averages pushing price down, these are the three confluences that you need to stay in the trade. So these are the two main things that I use alongside with volume and VRVP, which I'm going to let Kevin explain that. But another tool that I utilize is RSI.
Wait,
And
JP.
go
Before
ahead.
we move on to RSI, like again, I want to make sure people understand, because you know when I first started trading, I did not have YouTube, so you know there's a lot less resources, and now these days, you know, there's a lot more resources on YouTube. There's a lot of misinformation, and you know the EMAs and SMAs, they're one of the most common indicators, especially these days, because people, when you look back at it, it looks very pitch perfect, right? 2020 hindsight, you know, there's a crossover, amazing entry you get in, right? But the main question is, how exactly do you enter based on this, right? Because you're looking at this in live time. You know, the crossing might be a little bit more intricate to time, right? So what do you personally do when you get into a day trade? Well, what do you wait for? Like, yes, you talked about the crossing. Was there a specific, like, you know, the second the SMA's candle closes and it's a cross, that's when you enter?
Absolutely
Or
not. I do not
okay.
use EMAs for nothing more than confluence to my already decision to take a position. So because I do use um, 4 hour levels, right? I draw levels on a 4 hour and 8 hour chart. If I see price rejecting a level, and at that point, I see that price is going to push down because volume and price action is indicating that we've gotten toppy, I'll take the trade, and then I'll use the EMAs for confluence to stay in the trade. So if I'm in a trade short, and then while I'm in that short, that 9 and that 21 cross, I know that I'm in the right. I'm in the right trade.
Gotcha. Okay. And then similar to this, actually, okay. So let me ask you this: since you've been trading these SMAs and EMAs, do you think it's an indicator best used in your experience for entries, or more for keeping you in the trade?
Keeping you in the trade.
Gotcha. I'm glad. I knew
You
you were gonna
can,
answer that
if
way. Yeah.
anyone who's taking trades based on EMA crossovers is basically, lottoing because they're lagging. So you're going to get into the trade late. However, there is one true signal to EMAs that is a for sure thing. When those EMAs are all stacked together, like the 9, the 21, the 15, and the 200 are trading tight with each other, and as soon as price action breaks below all of those EMAs, you can rest assured that you're in a hell of a great dump or pump. So if you wanted to wait until all of those EMAs are stacked together, like really, really tight, like coiled together, is there anywhere in this chart where you can show that all the EMAs were aligned with each other? Can you zoom out a little bit? Let's see if we can find one.
Uh,
Can you go?
uh,
I just want to find like a decent one. There isn't one.
no. I mean,
There
it's gonna
isn't
be
one.
very hard with the, you know,
Yeah, it's gonna
with
be hard to
the
find it.
6 1. Yeah.
Yeah, but I mean, when those EMAs get really, really tight together, if all four of these are super tight, you're good to go. But the other trick of the trade is, for example, if you grab, um, if you're only using the 9, the 21, and the 50, and you're using the 200 as targets, that's also a great setup to take.
Gotcha. Okay. So yeah, I mean, I'm glad I asked you that question because I knew how you're going to answer it, and I think it's very important for people to hear. Majority of indicators are best used as keeping you in the trade indicators versus entry. Um, JP knows this. I know this. The greatest indication for entry points are usually price action. That price action volume, that most of the time is what gives you, what your entry points are. The indicators such as SMAs, EMAs, I always disagreed about it being entry points. You can technically use it as an entry indicator, but it's really great for keeping you in the trade. Just as JP said, it crosses over. What's the reason of if you got into Nvidia puts? What's the reason to get out of them as long as the, red line is still above the yellow line, right? So, yeah, I'm very glad you brought up that point. But yeah, we
And
wanted,
then and
yeah,
yeah, and then the next thing that I use is RSI.
oh yeah. Let me just remove these.
And I use standard RSI, just your relative strength. And basically what I use RSI for what it is, which is a momentum oscillator. So it gives me areas of overbought and oversold. It's not necessarily a true gauge of entry or exit because a lot of people are like, oh, it's overbought it's above 70, it's overbought, it's oversold. I'm sorry, it's overbought, it's under 30, it's oversold. That's not necessarily always the case. Stocks can remain oversold and overbought for longer than you can stay rational, right?
Yep.
But when you use RSI, relative strength index, in correlation with all your other confluences, it gives you an indication of if the move to the upside or to the downside still has the necessary velocity for it to continue to the upside or the downside. The funny part about RSI is that a lot of people use it to trade divergence, in which, for example, price action is going up, but relative strength is going down. And that's a true divergence trade where you can make a lot of money because obviously if the strength is weakening and price action is pushing up, that's a divergence. And then you catch the divergence. But for me, because I'm a price action level to level trader and I use EMAs, I use RSI for what its intended purpose is for my trading style, which is just to find continuation of strength in a move.
Do you want
Because
me to add on? Yeah, go on.
no, because remember, you can remain overbought or oversold for a very long time.
As you can see, yeah, I literally circled it.
Yeah,
Examples right here. Everyone always says like, oh, above 70s, oversold, above below 30s, no, overbought is above 70, oversold is below 30. But you could clearly
yeah,
see here, I circled the two areas, and I'm gonna let JP continue. But you could see like January, how many days did this last? I remember so many people were using RSI during this time, and they got burned because Nasdaq was just going up. How many times? How much? How long was it quote unquote overbought for? And then again, in May of this year, there was a whole uh, 2 month stretch where it was overbought, and still, people are still trying to be short because it's an overbought. So yeah, go ahead.
yeah. So that's pretty. I mean, I also tie in volume and VRVP, but I'm gonna let you explain those two. A lot of people look at my charts and they say, "Oh man, you have a lot of stuff on your screen." I don't care what other people think. Um, it's what makes sense to me. Um, I like the squiggly lines on my screen. Um, it makes me feel comfortable. It's kind of like a safe place for me. Um, I don't know. I've tried trading naked before, and even though I can see the move, there's something very comforting about having these lines up on my screen just for confluence. And that's what works for me. I'm nowhere near as good as Kevin when it comes to recognizing price action. So maybe that's why I need these lines on my screen, but this is what works for me. before I hand this off to Kevin, one of the other things that I do incorporate into my trading is level twos and time and sales, but that's in a completely different subject matter in which we're using live real-time data, second to second, to recognize price uh, and the amount of shares that are being bought by every millisecond. But if you don't have access to that, you can easily just trade anything similar to how Kevin does by recognizing price by just reading the candles. So that's it for me when it comes to the indicators that I use. And I think, Kevin, the thing that most people want to know is what the hell is VRVP and what's the difference between volume on the bottom and the
Mhm.
visible range volume profile on the right, and how are they correlated?
Yeah, absolutely. I'm gonna get in that in just a second. I just want to reiterate the RSI because it's been used. It's been the usage of it has been increased the past year and a half. So I just want to talk about the proper way to use it. Similar to what JP said, if RSI is doing one thing and then price is doing another, that's called a divergence. Some things you just gotta keep very simple. This ties back to what I said earlier about how indicators are not really entry points; they're more keeping you in the trade. When it comes to RSI, it's a little bit similar to that. I think RSI is just a giveaway at a potential trade, but you can't necessarily go just based off of it, right? You could see here, I pulled up meta chart. I show you the NVIDIA example, for example, NVIDIA chart, for example. You have price that's at a stable point, right? You have price that's going, it's rejecting, it's going across, but it's still testing around this area. Meanwhile, RSI is going down this way, right? So overall, it's bearish, right? But you could see, yes, you could have tried pairing uh, trading the bearish setups, but you have to be very precise with your entries, and that's the point I want to get across, right? You can't just look and say, hey, there's divergence, I need to take a trade. No, that's the dumbest thing you could ever say. Just because there's divergence, similar to what JP said, there's no guarantee that the stock will go down or whatever you're trading will go down when you expect it to, just because there's divergence. You need to tie that in with multiple things. Of course, the most important thing is price, right? What is price doing? How's it reacting? Is it near a level, right? You can't just take a short, or you can't take a long, or you can't take calls and puts just because there's divergence. Is it near a level? How's it reacting to a level, right? There's many questions you want to ask when trading this. And I think the thing about RSI is it's very selective in the markets it works with. It's not a indicator you can use in all types of markets. And that's the downside to indicators, right? For example, SMAs, as JP was saying, it is one of the best swing trading indicators that you can ever use. But in a range market, it is one of the worst indicators you could ever use, right? So you have to be very selective with what you trade and what you use to trade, because each thing has a different purpose. RSI, for example, is not the greatest thing in. It's a mix. You could say it's really not great in range markets. You could say it's really not great in trendy markets. You could say either way. That's why I'm not a huge fan of RSI. I think it's one of the most misused indicators, and it eventually gets people burned because the divergences will work for you, 6 set of months, but then the rest of the 6 months it will kill you, right? And that's why there's a lot less. That's why RSI trading kind of died down a little bit ago, until its recent introduction into the primary used indicators. But the main point I'm trying to get across before I go into VRVP is, if you do use the RSI, which I know a lot of people here use, you have to be really precise with your entries, and it's not just because there's divergence. And I know JP can attest to this. Like, you have to see how price is reacting again to a level. Is it rejecting? How are the wicks looking? How is the volume looking? There's many things you have to ask. So just keep that in mind. It goes in with any indicator, but I think it especially goes in with an indicator like the RSI.